Welcome, Paula. So what are you seeing that Howard Schultz is not seeing?
We're seeing from a ton of different data sources that high-income consumer spending is sort of the last leg of the stool that's really supporting U.S. economic growth. What we're noticing and why we expect a slowdown over the next 12 months is high-income consumer spending, high-income consumer sentiment is actually below that of other consumer income cohorts. That's a really important flag that we've tracked. The other thing that we're looking at is real personal disposable income is actually negative, down 4% year over year. And so if you put those two things together, what we expect is that over the next 12 months, with equity market volatility, that on that consumer spending will slow. In response to Howard Schultz's comment, though, I think what's important is that what we'll expect is trade-offs between consumer spending categories. So it's not that all sectors will fare the same, but given that we're seeing higher interest rates, lower real disposable income, it's really those real durable goods categories where we expect to see material slowdown in spending. And that's where we've seen it already.
Well, that's why it's been so confusing to track what is going on with the consumer. Even if you look at the profit warnings from a Walmart or a Target lately, it's not like they're talking about demand falling off a cliff. They're not talking about traffic declines. They're talking about shifts in prioritization and getting inventories wrong because of the sudden nature of the move. So it's really hard to tell what the underlying trend is.
It's really hard to tell. I think this is a complicated environment for investors. Not only do you have high inflation and slowing growth, but you have the impacts of COVID, which have really shifted the way consumers behave. So I do believe, stick to our call that over the next 12 months we'll see a change. But again, you'll have to look beneath the surface at some of the moves between categories.
What about service? Because where we have seen the biggest pockets of strength in earnings and right now in stocks is travel.
Yes.
Hotels,
yes.
Casinos, really no evidence of slowdown, and we're not hearing it from those CEOs.
That is where we'd expect to see continued strength. So the services rebound, especially on the back of COVID, is where, pent-up demand for travel and leisure is really coming through in high-income spending. So we expect that to persist through the fall, but then again to start to slow down thereafter with continued equity market volatility.
So next year, this all catches up, or what?
We continue to slow down until the, sort of the recession subsides. Services will hold up. It'll do better than goods, but by next year, I think we even start to see some slowdown in services.
So what does that mean for investors when it comes to the retail stocks? Because it's been winners and losers, given the categories and the income groups that different companies have focused on.
So as you know, we're long-term investors, so we're less focused on individual stocks today. But the big themes that we're invested behind are personal care, vehicle maintenance, nesting-related stocks or names, and those are goods that names that will benefit from the COVID, theme, where more individuals are staying home longer, and so furnishings, their offices for remote work, or even food at home. We expect those themes to continue to persist.
So obviously, it's an economy that is driven by consumer spending. Not recession yet. What do you think?
We actually expect a recession over the next 12 months, right? But a mild recession at this point. What prevents us from thinking this is a GFC-type severe recession is there's actually a lot to be excited about in terms of balance sheets that are still very strong. The labor market is still very strong. So even though I'm talking about a material slowdown in spending, it's not that I expect a GFC-type contraction.
Financial crisis, yeah.